All right. Well, thank you everyone for joining. Thank you so much. We are excited to be talking about the changes to the research and development tax credit. The good thing is, if you've never claimed it, the benefit remains exactly the same. So we want to keep this as fun and interactive as possible. We invite you to ask questions. Please pop them in either the chat or the Q&A. No matter where you put them, we'll get them answered, and we'll address them at the end of the presentation. So thanks so much. I am Maggie Crowley, your hostess with the mostest today. I'm head of strategic development here at Leyton, and I'm joined by Devin, who's the real brains behind the operation. And Devin is one of our team leaders and senior consultants. His expertise is on the financial and the tax side. So thanks, Devin, for joining us today. And thank you to everyone who's dialed into the webinar for joining as well. We're excited to talk about the R&D tax credit. So we'll get right into it. Just a little bit of a brief history about who we are. We are Leyton. We're actually a large global consulting firm. We just celebrated our 25th anniversary, and our business model has really been to identify countries where the R&D tax credit is a really good initiative and open up an office there. So at this point, we've got 25 years of experience. We have offices in 12 countries, 34 actual offices, and over 2,000 employees, all assisting businesses with the research and development tax credit and beyond. And the whole point of this R&D tax credit is to help businesses who are investing time and effort and money in innovation to help them sustain that and allow them to keep going and funding that innovation. And the unique approach that we take to our studies is we have both someone from the tax sector like Devin, but then also someone from the technical side. So if you're an engineering firm, we have engineers on staff that you'll be working with. If you're in life sciences, we have someone who has a PhD in various different industries. So it ends up being a really nice, unique approach for our clients and fun. They get to talk about what they love doing. So I'm going to provide you guys with a pretty brief overview of the R&D tax credit, and then we'll dig into how it's calculated, and then we'll discuss the benefit and then talk about what's changing. So as many of you know, I assume, the R&D tax credit was first introduced in the 80s. And back in the 80s, it was a credit that was really taken advantage of by larger firms like Google, Apple, businesses that were making a change and disrupting a whole industry. And in 2015, and there was something called the PATH Act that was introduced, and it changed the tax credit and it made it available to a number of different businesses, regardless of the size of industry. And they didn't, the biggest change was they didn't have to be doing something that was new to an entire industry. It just had to be new to their business. So it really became an incentive to help individual businesses grow as opposed to helping a particular industry grow like it was back in the 80s. And I think this change that happened in 2015 is still something that a lot of businesses aren't even aware of, that they have this credit that can help them. And the beautiful thing is that this is a retroactive credit. You can look back by 3 years. So if you haven't claimed it before, you're not missing out. So what the credit does is it offsets your income tax liability. And if you're 5 years and under, you can use it to offset your payroll tax liability, making the assumption you might not have an income tax liability yet. So Devin, let's get into the nuts and bolts. How do you actually qualify for the R&D credit? I know we could probably say like, yeah, you qualify, but there's got to be a test or something that the IRS has.
Yeah, thank you, Maggie, and thank you everyone for being here again. So yeah, I think there's a detailed slide on the 4-part test, but basically, like Maggie said, it's been expanded year over year because it's so beneficial to the economy and creating jobs and lowering companies' tax liabilities so they can continue to grow. So it's been framed to fit any business potentially. And there's 4 parts of the test. Basically, one is that what you're doing as the company needs to be connected to what you're selling. So that could be a product, a service, whatever you're making, whatever you're creating as a company. The work in which you're claiming the credit around has to be related to that product. So the business component. Second thing is that it's scientific or technological in nature. So based in the hard sciences, Maggie alluded to some of the main industries, computer science, engineering, hard sciences like dental, physical science, physical therapy, etc. In vitro fertilization, whatever you might think of that's based around science. Then the last 2 tests are that there has to be a level of uncertainty in what you're doing. You're not necessarily doing R&D if you already know the answer flat out, black and white, and it's the same thing maybe you've been doing as a business for 10 or 20 years. And with that uncertainty, there's a process of experimentation to try to figure out the answer to what you're developing, what you're improving, what you're creating. So a level of uncertainty and a process of experimentation, whether that be by trial and error, the scientific method, whatever you might think of, those are the all-encompassing 4-part tests.
So to put this into perspective, for those of you on the call who are business owners, this is a case study of an engineering firm, and some of the first part of the 4-part test is under the key R&D project. So they improved machine with subsystem redesign and integrated control system, design and construction of a new robot cell, improved actuator design, and development of a new vision system. So I think what we often hear in when we're doing R&D studies is that people are surprised by the projects that qualify. And there are some really like simple projects that end up qualifying that people often would think, well, that's not R&D, that's just part of my everyday business. But it is in fact R&D.
Yeah, and just you'll see there in the examples of the project, this sort of thing we spanned 4 years. So that entails a lot of the owner and the key stakeholders like the CTO or the main engineer on staff to do some retroactive thinking. What did we do that was new or improved over the past 4 years? So that's the initial conversation. From there, we kind of map out the projects, which ones correlate to which years, which tax years we're looking at. For instance, now it would be, we would be looking at tax year 2022 and possibly backward all the way to 2019. Once we get kind of a roadmap of when the projects occurred, then we can start talking about what were the major milestones, what were you trying to figure out. You can see the projects can be, as long as they're based around that 4-part test, based in the hard sciences, they can be something either improved or just completely new, designing a new product or improving upon that actuator design, for instance. And neither Maggie nor I are engineers, but that sounds pretty legit.
But you haven't designed actuators?
Not yet, maybe in 5 to 10 years or something, but yeah, that's kind of how we go about mapping the projects. And from there, which we can get into a little bit more, then there's a process of tying the costs to those projects.
You guys are probably wondering, how do these folks get 80K for 1 year and 210,000 for 4 years? Well, we looked at 4 categories. And Devin, what actually goes into when looking at these 4 cost categories?
Yeah, so the main obvious one is going to be, as your company, who on staff was working on the projects, the framework, the design of it, the implementation, the prototyping, the testing. There's a lot that goes into creating something new as a company. So who on staff was working on it? And then the main component to that is that the IRS doesn't require time tracking on the part of a company. They don't expect every company in the US to have a time tracking system. So then it's a reasonable estimation on your part as the business owner what's an estimate of the amount of time or the percentage of time out of the working year that each individual contributed to this. So that can be direct supervision, hands-on, say like in a manufacturing line, the people on the line producing and testing the products. And it can also be a level below direct, which is support level staff. So in the very traditional example of like a pharmaceutical firm, for instance, testing some sort of new vaccination, you have support staff cleaning the assembly line, cleaning the beakers, that sort of kind of support minuscule tasks. Even that, if it's directly related to the project, can be included. So that, along with subcontractor 1099s, it's a very similar process. Who worked on it and what's the estimate percentage of their time? That allows us to qualify a percentage of the wage or the contractor cost. And then really it's a similar process for supply costs as well. If you're prototyping something, that's probably a separate line item. We can say these were testing costs, batch run costs, sunk costs in developing the product before it was commercially available. And the last one, computer leasing expenses, is essentially for software firms. They might be using AWS or some sort of other cloud computing expenses to run their platform, help develop it, etc. So those four costs are what can go into the credit, and the word for it is qualified research expenses, or QREs, and the credit usually equates to about 10% of that total.
Nice, thank you. Well, I imagine people are wondering what the actual difference is between a tax credit and a tax deduction. And that is super important to understand, especially as the R&D credit, it's changing. So Devin, do you mind explaining what the biggest difference is between a deduction and a credit?
Yeah, so we'll keep it real simple. If you look at the left side of the numbers versus the right side, this is basically an example of someone or a company not claiming, and then on the right, you are claiming the credit. So a deduction is very simply just a business expense. You take deductions on your tax return for wages, supply costs, everything that goes against your sales or your revenue. That bottom line, after you subtract expenses or deductions from sales, is what your taxable income is. That's what you pay a tax on. So example on the left, $1 million in taxable income after $1 million in expenses, 21% corporate tax rate, assuming that's your tax liability on the left. If you're just a normal company who's never heard of the credit, for instance, then a credit is what is called a below the line benefit. So basically it's, you have your tax liability, and that at the very end, you can dollar for dollar offset that liability with a credit. So it's different from deductions, which are above the line. They kind of indirectly lower your taxable income, but it's not dollar for dollar against what you might be expected to pay. This example on the right, you take a $100,000 credit. We won't get into it too much, but you can't double count those expenses towards both deductions and credits. So if you're taking a $100,000 credit, your expenses are actually going to be 100,000 less. So you can see taxable income goes up by that credit amount. You would think if you stopped there right at tax liability, what's the point in claiming a credit? I owe more tax now. Now, though, you have that 100,000 directly reducing tax liability. So you can see the benefit is basically that $100,000 credit net of the tax rate. So net of 21%. So it's a $79,000 tax savings.
So you're telling me a credit is probably better, huh?
It's good. It's better.
All right. Well, I think a lot of people joined, Devin, to hear about what's changing. So let's get into it.
Yeah, so this one, this is a change that was implemented by the IRS as of tax year 2021. So we've been dealing with this for over a year. It's really pretty simple. It's basically a little bit more of an inundation on the taxpayer's part just upon their filing. So this change basically says when you're filing for a refund claim, so that would be for an amended tax year, not for the current tax year, you need to attach this statement basically saying who worked on the R&D, what was the project, and what is their title, and a very brief description of their duties within the project. So you can see the IRS citation and the memo number if you wanted to Google it, for instance. But on amended returns, you need to identify the business components, which are basically the projects that you're claiming the credit for, each individual involved, and then what was their contribution. You could say this person was a lab technician. They helped, going back to like the clean the beakers support level example, and then they helped run like testing analysis for our prototype, something like that. A couple sentences. It's easy enough because this is basically the analysis that would be done if you're claiming a credit. This, for instance, us at Leyton, this is what we would be talking to you about in gathering those employee percentages. If you tell us someone worked 50% on this project in 2020, we're inherently going to ask you, okay, what did they do? Is this legitimate? This is really just a matter of getting it all on paper, providing it to the IRS. And the reason for this change largely was just to, I think, file out some of the untrue claims right away. So some people were basically just taking a pen to paper and coming up with a number out of thin air, like we'll qualify 20% of our wages and it'll probably never get caught. There does need to be some analysis and some initial proof now. So I think that was the main purpose of the change.
When we do this, we refer to this as our substantiating report. It's something that we've always done, and now it just happens to be required. Now let's get into the 174 changes.
Yeah, so this is the main change, the main thing we're going to focus on for the rest of the presentation. And hopefully some of you or your CPAs have kind of glanced upon this at this point, but basically the Tax Cut and Jobs Act, the TCJA of 2017 under the Trump administration, that was the one that cut the corporate tax rate to 21% from 35%. And part of this was something to be implemented for tax year 2022 and onward, affecting not really the credit so much as the R&D expenses that go into the credit. So we'll explain what that effect was, but basically the initial purpose of this, like I said, when the corporate tax rate was cut, the federal government basically needs to make up that tax revenue somehow. So this was part of, although delayed, it was part of a mechanism to make up some of that money elsewhere. So basically the meat of it, the expenses going towards a credit, those QREs, the qualified research expenses, those used to be able to, like in the example we showed, used to be able to just be fully deducted. And then along with that, you take your credit. So double benefit in a way, but you would, even if you were claiming the credit or doing research as a company, those wages, the supply costs, the contractor costs going into the research could still be fully expensed on the return in the year in which they're incurred. Like we said, this 0.4 we already kind of covered. It was to make up some of the federal revenue. So the change is that now the expenses going into the credit each year must be capitalized and amortized over a 5-year period. So the first thing is that this doesn't affect the credit calculation. So in the example I said, the credit usually, there's 2 calculation methods. It might be a little bit more or less than 10%, but it's usually about 10% of your qualified expenses. So if you have R&D expenses in 2022, the credit's probably going to work out to about 10%, 10%, 10,000. That's not going to change. So that's an important thing to keep in mind. The credit's not being amortized or capitalized. It's just the expenses going into it. So with that example, 100,000 in R&D expenses, you would need to amortize those over a 5-year period. So we'll define what amortization and capitalization and all that means, but that's the essence of it. Instead of taking it on year one on your tax return, you need to extrapolate it over a 5-year period. So the impact, just thinking very simply, is a negative one for your taxable income until you have a few years worth of credit and amortization going on to try to recoup that increased taxable income, that increased tax liability due to this change. But we'll illustrate that. There's a few graphs which will be helpful. And we can define these terms a little bit.
So this seems like this is now morphing into more of a longer term tax strategy.
Yeah.
For businesses who are going to be continuing to do innovation, R&D, this is still absolutely something that they want to claim and take advantage of.
Yeah. So real quick, just to basically, as business owners, you probably all know these terms. Every business will have like assets on their depreciation schedule, say like a company car or a building or a big piece of machinery or equipment, for instance. But to capitalize is to record an expense on the balance sheet. So it's not to expense it fully. Say you buy $100,000 car. That's not just going to be able to be expensed and deducted fully on your return. You need to capitalize it, place it as an asset, and then expense it over time. So most people, like I said, see depreciation. Amortization is a little bit more rare to see, but it's the same thing. When you capitalize and amortize an asset, that means the asset technically is intangible. Depreciation is a physical asset, but it's the same concept. It's the yearly expensing of that asset that you capitalized. So it could be 3 years, 5 years, 7 years, 30. I think 27.5 is one. There's all sorts of different categorizations of how long you expense an asset over, but it's all the same thing. It's recognizing that expense over a period of time versus doing it in year one. The purpose of that mainly is to not artificially lower taxable income. Say you bought a building and it's $500,000. The government just doesn't want to let you take that $500,000 in expense in year one. It needs to be over time. And it kind of correlates more closely to the use of the asset, the lifespan of it. So that's the main concept.
Thank you. It's definitely helpful to understand these words are, I mean, I know people who own a business get what they are, but they're still complicated. Yeah.
This we can go over quickly. This basically, the thing to keep in mind is to show that even though this law is now enacted, right? It's 2023. We're looking at tax year 2022. Nothing was reverted or rescinded in December like we thought it might be. So the impacts of the change, we're able to guess, for instance, that you're going to need to place this R&D expense asset on Form 4562, just like all your other capitalized assets are. You'll need to show the yearly amortization of the asset on this, other detail sort of statement at the bottom there. There is a revenue procedure. That bottom bullet, 2023-11, is the most recent one. And this provides guidance on the attached statement that you need to do in your 2022 return to allow for this accounting change and start following the rule, essentially. So they lay that out. There's 6 steps to do. That's a short read, that RevProc. So this is something, versus us as a consulting firm that focus on the R&D credit, this is something that your CPA is going to need to be aware of, just kind of the logistical ins and outs of what the change means. But those are the sort of things we can expect, at least. There's just no definitive guidance on it yet.
Evan, I am the eternal optimist. So let's talk about some of the positives. Oh, I skipped a slide, sorry. Let's talk about some of the positives that come along with this change, because with all change, there's got to be something good, right?
For sure, there's a lot. One is that So this change is not retroactive. This is going into effect for tax year 2022. And like we said, you can already do a 3-year look back potentially. So we could still do a regular credit, don't need to worry about this amortization stuff for tax years 19 through 2021. So that's one thing. It's not going to affect the look back. You can still, even if this year is a little more complicated, get a ton of money from amending your returns, and it's just that quick attached statement to do. That's no problem.
And I would keep in mind that example we shared earlier, that engineering firm got back $210,000 from their 4-year look back. So it is totally valuable and definitely not something that companies want to overlook.
Yeah. Another one, if you think conceptually, just this effect to not being able to fully expense the research costs, it lowers your expenses, it increases your taxable income, it increases your tax liability. Then of course you still have that credit. But what point 2 is getting at is that you don't really necessarily care about taking less of a loss if you're still a company in a loss. You get to expense less, but if you're in a loss, it's kind of irrelevant. So this rule shouldn't really deter any companies still in losses or still carrying forward NOLs from claiming the credit. Nor should it, implicitly for payroll companies who the payroll credit is an election you can take. If you're not paying tax, you can apply the credit to your payroll tax, like Maggie said. So this change also really shouldn't deter payroll eligible companies either from claiming the credit. Another big one, most states, I think 35-ish, offer their own R&D credit program. And it's been suggested that many of those won't adhere to this change on the federal level. So that means states like California, Texas, Ohio, New Jersey, a bunch of other ones, they might not change their policy, and you can still claim the credit and take your expenses just like you have been in the past 3 or 4 years. That's another thing, not a ton of definitive guidance on it yet, but you can expect a lot of states not to adhere to the negative changes being implemented.
And there are many states where the credit is actually more valuable than it is at the federal level. So it's absolutely still worth taking a look at this.
For sure. Yeah, the big one, the illustration for point number 4, you'll see, I think it's easier to visualize, but you'll see that even if you need to capitalize and amortize your expenses, continue to take the credit, it is a profitable endeavor long term. By year 3 or 4, you start to make up the money, and it's profitable to continue to adhere to the rules and claim the credit. So that'll speak for itself. 5 is another big one. So basically, it's not this change is irrespective of whether a company claims the credit. That's the way the language reads. It reads essentially that if a company is performing R&D and has qualified research expenses, they shall capitalize and amortize their expenses over a 5-year period. It doesn't even mention or affect the R&D credit technically. It's if you're a company doing research, you must do this now. So that being a positive is maybe the wrong word, but the point is, if you need to do this as a company, you certainly might as well claim the credit to alleviate that increased tax burden by not being able to fully expense those costs in year 1. And the other thing is, following the rules can only lead to better things overall. When you talk about increased audit exposure for not following them, for instance, there's a couple scenarios. If you think about it, if you've been claiming the credit as a company for the past 5 years, say, obviously if you don't do it this year and you choose to claim that you have no research expenses, you're not going to follow these rules, if an audit were to come up, that would certainly be a little questionable. You're now all of a sudden, you stopped R&D in 2022, you didn't have any expenses to capitalize, you didn't claim the credit. That can lead to 2 things. One, the IRS insisting that you did have R&D and calculating it themselves, which would probably be an unfavorable amount. And two, the IRS opening your past years for audit, saying, if you all of a sudden, quote unquote, stopped this R&D this year, then that makes us question whether the R&D in past years was legitimate. So again, not necessarily positive, but I think a few good reasons to follow the change, even if it's a 1 or 2 year significant tax hit versus that that other avenue of risk. Yeah, so 6 real quick. We said that capitalizing something is to put it on the balance sheet, right? So in the case of an acquisition, there's not only the cash flow and the income statement and the profitability to look at, but there's also the amount of assets on a balance sheet. This rule technically helps that and is favorable for a company who might be trying to get acquired and wants to show as much in assets as possible. And then, 7, yeah, we'll touch on that as well. There's a lot of news and a lot of suggestion that this still might be repealed or at least delayed. And we'll get into that.
We just have a couple more slides, you guys, and then we will get into the live Q&A. There are a couple of people who popped in the chat asking when they could ask questions. So you may ask them, put them in the chat box with the Q&A, and we will get them answered. If you have to leave, we've dropped a meeting booking link where you can schedule time for a private one-on-one session to get all your questions answered.
Okay, I'll try to go a
Here's the
little quicker
visual.
maybe. Okay, so this is a good one to look at. Hopefully this chat thing isn't popping up for everyone. It's just us as the hosts, I hope. But basically the tax due over time, the graph at the left is what to look at. So if you adhere to the rules and capitalize your expenses and start amortizing them, then you conceptually think about 3 years, 4 years down the road when you have that many years worth of amortization expense going on at once. You have years 1 QRE, year 2's QREs, year 3's, all 20% or 10% of amortization expense building upon each other. So by year 4, year 5, year 6, it's as if it's the old way. You're basically taking 100% of your expenses. It's just 5 separate years of amortization expense going on. So year 1 and year 2 of this change being implemented, it is going to be a tax hit. But by the time you have several years worth of claims built up and you continue to utilize that credit, just the way it's always been calculated, you start to save money. Cumulative savings over time will show you the same thing. You know, probably by year 4 or 5, you'll be glad that you never stopped claiming essentially as a company, and you'll just be saving in tax consistently at that point. So if we're not able to directly address every single question, I've been offering to clients to do a little Excel model for them to show, you know, this sort of thing more catered to their expenses. We're always happy to do that, but hopefully you can see at least that this is an asset. It's a little more of a long-term one now, but it still is.
Well, I think, as you guys know, this has been a pretty hot topic in the world of tax. So some of the industry rumblings that we've compiled, they all sort of have the same message. In the same vein, the hope is that, and the thought is that this may get repealed and not actually be, this may not be long-term going into effect. And while we don't know as a firm, we don't know what will actually happen, but we can certainly pull from the news and make our own assumptions.
Yeah. The Build Back Better bill, which didn't pass, unfortunately, that was the most recent one that had this change within it. A lot of the times the issue is that, you know, there's the main meat of the bill is not bipartisan and doesn't have enough support, so they'll toss out the whole thing versus only taking components of it. But you know, there's a lot of lobbying going on. One of the main things to take into account is that bullet point at the end. The projection is that it's going to cost innovative companies at least almost 30 billion in increased tax liability due to this change. I would say that's even more of a reason to adhere to it. If companies they go through with the change and they are significantly hit this year, then it'll be all that much more pressure next year, years going forward on the election ticket, for instance, to get it repealed if the effect is tangible. But yeah, these bullet points are all saying the same thing as far as professional firms, firms that do R&D, consulting firms, all wanting to get this repealed. It doesn't really help anyone. And the essence of the credit was to reward US-based innovation and make companies more competitive. And this kind of goes against that. So that's the essence of this.
Well, we have several questions that we'd like to get answered for you guys. Sarah, are people able to actually speak or mics open as well?
They will be. Yep.
Okay. So why don't we start with some of the questions we have in the chat, and then we can also move to a live Q&A where people can, we can talk about it, guys. Talk about the changes. So one easy question is, we'll share the slides with everyone at the end of this presentation.
Nice and easy.
All right, Lorraine Minatoshi is wondering, will Leyton fill out the 4562 form for my accountant? Very difficult for small businesses to deal with the paperwork.
Yeah, so that kind of goes in line with the rest of our deliverables package. Technically and legally, we're not tax preparers. So we're not going to be able to fill out a form and provide it directly to your CPA and just say, throw this into your return. It's similar to the 6765 that is required for a credit filing. What we do is basically provide a line-by-line draft. So it's watermarked with draft, so you can't just throw it into your return and we're responsible as preparers all of a sudden. But both with those draft forms, submission instructions, and also, further support down the line if ever needed through email or call, we'll certainly steer you in the right direction and tell you everything you need to know as far as the filing and everything your CPA needs to know. We just won't literally do it for you.
So that's done by our CPA?
Yeah.
Thank you. I appreciate it.
Yeah, that's done in conjunction with your CPA and us, basically helping them along the way in whatever way they need. But yeah, ultimately done by your CPA.
Okay. And
Grady
she can,
Davis.
she
Oh,
can
sorry.
call in to my advice, to Leyton, right? If she has
Yeah.
questions.
Yeah, throughout the process with our clients, even on the initial call, which is no obligation, by the way. Like if we have a call and determine that you don't do R&D, then we're not going to charge you or anything. But point being, from the very initial step along through the process and after the end of it, we encourage your CPAs to be on those calls, ask as much as they want, be involved as much as they want, and we'll certainly be in communication with them.
Okay, thank you.
Grady Davis would like to know, what is the typical amortization time for software development?
So this rule specifies that it's 5 years, just no matter what. My example of an amortization period, just, being that variation like 3, 7, 15, 30, that's just an example of what's been determined for other assets. But this one reads 5 years, no matter what sort of firm you are. That's the period for your qualified expenses.
So Dimitri is wondering, if we pay an outside firm to work on R&D projects, their costs qualify? Well, Dimitri, their costs likely do qualify. We can't be sure unless we know exactly the work that they're doing, but you can include costs from outside firms.
Yeah. Only specification there is that they have to be US based, not only physically, but like the entity that you're paying needs to be US based. It's a from inception, something to reward US spending. So that's the stipulation for contractors and employees. But yeah, definitely what Maggie said.
I thought if not US based, it was a longer amortization period.
For the purposes of the credit, you know, in order to utilize those costs, they need to be US based. So yeah, so the amortization and that being considered a qualified expense would follow those same rules.
Now, on the amortization, you said something like after 4 or 5 years, you would break even, basically.
Yeah.
But the way I do the math, I don't think that's true, because it's actually amortized over 6 years, right? Because you get a half a year at the beginning and a half a year at the end.
Yeah, that's true. Yep.
So if you do that on a spreadsheet, the most you ever get is 90%.
Yeah. So I see what you're saying as far as like 5 years being built up on each other worth of amortization expense, you're still only getting 90% of the deductible cost total, say if it were the same amount every single year. What makes it profitable even before that, though, is the fact that you still get that credit. So you're right if you were
I already get the credit, but I see what you're saying.
Yeah. And it sounds like, you know, a direct conversation, like work with your numbers sort of potential opportunity. But yeah, I guess that's my answer to that.
Okay, I got it. Thank you.
So Stephen Habib, who's joined us, is 3 or 4 years from retirement, and he's wondering why he should still apply for this credit, even though he's about to sell his business.
So one is definitely that the credit can offset your capital gains as the owner when you sell. Say, for instance, the company is still, or it probably isn't, but say it's still at a loss, and you sell, and all of a sudden as the individual owner, you have all this AGI derived from the company that you sold, and you need to pay huge capital gains tax on it. If you did have carry forward credit from that company, then that would offset that big capital gains tax before you're completely wiped your hands of it. But the main answer to that, I would say, would be if you have been claiming as the company before this. It goes back to that risk, and you certainly wouldn't want an audit to lead to a big tax liability right before you're trying to sell. If you have never claimed in that sort of situation, then, you know, it's the IRS is, it has a huge budget for increased hires. And I think it's like 10 billion. So they're going to hire a ton of new auditors to explore this sort of thing. There always is a small possibility that they're just going to be looking for companies at random, maybe by industry, and saying, you do research, you should have been capitalizing and amortizing this. So my answer mainly pertains to the risk of not, if you're truly doing R&D as a company. But if you're planning on selling, maybe it's iffy whether you're doing R&D and you've never claimed before, then maybe it's not optimal.